Welcome to episode 83 of Accessible Finance for Retirement. You noticed 2 extra words at the end there because we want to better reflect the conversations that we're having on the show. And that's largely attributable to the tax complexity that makes them more interesting to have.
Absolutely. So to that end, we are starting a 3-part mini-series that are focused on Roths. Today's episode is on Roth fundamentals, and they'll get progressively more detailed and in-depth as we go through the mini-series.
I'm excited.
Sound good?
Very
All right.
much.
So before we dive in, let's briefly talk about where the Roth accounts came from. They've been taboo for quite some time, but they've become a lot more mainstream. They weren't created until 1997. And Eric, you know where they initially
Yes, it was
originated?
a congressman that wanted to use the rules. No, I don't know.
Yeah. Senator William Roth of Delaware sponsored the legislation. Okay, so let's start out with the Roth IRA basics.
Okay.
It is the most common type of Roth account. So let's start out by comparing it to a traditional IRA and what those key differences are.
Got it. So traditional IRA means you're paying with pre-tax dollars, which means you're not going to pay federal income tax
Yet.
or state income tax on those dollars when you deposit those dollars into the account, right? So that typically looks like deferring salary into your 401k. You will pay the FICA taxes, which refers to the Social Security and Medicare component. However, also called payroll taxes, or you'll hear self-employment taxes. That's all separate and apart from income taxes, federal and state. So you're going to deposit or defer those taxes. You're deferring taxation on them into your account. And then you pay ordinary income tax when you withdraw the funds later in life from the account, and potentially penalties if you don't follow the rules.
That will be a running theme here.
Yes,
Penalties and interest if you don't follow the rules.
correct.
Okay, so with a traditional IRA, you get the tax deduction on the front end.
And then everything that's pulled out, regardless of the character of the investments within the account, is going to be taxed at ordinary income rates. What I mean by that is you could potentially, and very likely should, if you're a young person, have large amounts of equities, if not entirely equities, in your 401k right when you start. Okay, so that's a tax-deferred account, has a ton of equities. So some people think, hey, long-term, I held this for over a year.
Yeah.
Why is this not taxed at a 15% long-term capital gain rate, assuming I'm in that bracket, or
Sure.
0% or 20%?
I'm sure that everyone is thinking that.
They very well could be, right?
So people who are informed enough about, I would say the majority of people that we interact with tend to have their eyes glaze over when we start talking taxes.
It's so much fun, though. There's so much opportunity.
But for those that are more comfortable being in the weeds or more familiar with the different types of taxation, it would be reasonable for them to think, okay, if I've had long-term equities, that's going to be taxed at long-term capital gains.
Right. The thought is that maybe I'd be able to pick between the more favorable tax rates, and capital gains will always be more favorable than ordinary income, given your brackets, right? So the idea is that regardless of the character of the gains or appreciation of these assets within the tax-deferred accounts, when you take them out, you're taxed at ordinary income at both a state and federal level.
That's a good point.
So that's important. The Roth account, however, is the inverse. So I pay all the federal and state income taxes on the front end, and then when I take the money out, it avoids that completely, provided it is a qualified withdrawal.
Right. So again, you have to follow the rules for withdrawals for both accounts. But the significant difference is the tax treatment of the funds as far as when it is taxed.
Correct.
Okay, beautiful. So let's discuss, there are contribution limits.
Yes.
Right? For the Roth.
Correct.
And, something Eric really likes to say is that the reason for the limits is because the account is so very favorable.
Correct.
And so very, very important to be mindful of what the limitations are, what the rules are, and to participate in the years that it is advantageous for you.
Correct. So in this episode, we're just talking about direct contributions.
Yes.
And so there are income limits. So like when you make above a certain amount of income, you're supposed to be disallowed or prohibited
Correct.
from making direct contributions to your Roth IRA. And in fact, you are. You can no longer make direct contributions. However, there are ways around it that we will discuss in the next episode called Roth conversions.
Yes. And you've also heard Eric discuss backdoor Roths on previous episodes as well.
Which is simply an annual Roth conversion.
Yeah. So that is, like we said.
We'll set that aside, though, for now. And we will say, though, that
it's coming.
When you're trying to just make the most straightforward contribution to your Roth account, which, well, logistically, that just looks like, some people will say, like, wait, what does that mean? Like, how do I do that, right? You can just have a taxable brokerage at, say, Schwab, Vanguard, Fidelity, one of the low-cost brokerage. You could have it anywhere, but that's where we would suggest typically.
Yeah.
Have it at a low-cost brokerage, and then you will just go to the move money. You'll create your Roth IRA account, and then you can just go to usually move money from one account to the other account, your taxable brokerage to your Roth. And they'll typically ask you, hey, what is this? It'll say, like, is this a 2025 contribution? And then if you were between, January and April of next year, because you have until the unextended tax filing deadline, right, of your personal return. So typically April 15th, April 16th, somewhere in that ballpark. You'll be able to make it for the previous tax year. Does that make sense? So in April 2026, I could still make a contribution for
in early April 2026.
Early April 2026. For March, for sure, we're good, right?
Sure.
But the idea is that logistically, all you're doing is you're logging into your account and you're just transferring money.
And then once that money is transferred into the Roth account, it's not suddenly like doing magical things. One thing that we've definitely had to clarify for many people is that the Roth account is simply an umbrella account that specifies the type of taxation. It's not in and of itself an investment.
Right.
So there are still investment options that you would choose. And typically we advise the highest return, right?
Expected
highest
return.
risk. Yeah.
Highest expected return, highest risk in terms of like standard deviation, however you want to measure that, right? Well, not however you want to measure that, typically in standard deviation.
Yeah, true.
Or beta.
Yes. But precisely. So setting up the Roth account itself is very simple. Transferring the money into that is very simple. So then you're left with needing to know what the limitations are on how much money you can actually transfer into that account as a contribution.
Yeah. Just so you guys know, the ballpark phase outs, individual, we're talking about 150,000. That's when the phase out would start to kick in. If you're a single person and your modified adjusted gross for Roth purposes is 150,000, then you're going to have to start thinking about, another strategy to get money into the Roth.
Right.
Again, we'll talk about that later. If you're married filing jointly, it starts at 236,000. This isn't 2025. So that's what you're talking. And then when we talk about limits for the contribution, in 2025, it's $7,000 per person. And again, retirement accounts, or IRAs in this case, are individual. So there is no joint IRA. Even though Rachel and I make contributions every year,
correct,
it has to be $7,000 per individual.
Yeah.
Right. So it can be $14,000 per married couple, but it's $7,000 each.
Yeah, into each account.
And then the only other the other restriction on your contributions is that you have to have earned income to substantiate that.
Correct. So if I was to only earn $6,000 in a year, right, then I couldn't contribute $7,000 that year.
Correct.
I'd be capped at $6,000 because that's what I earn.
If you're single, if you're married filing jointly, then you can use both spouses' income to substantiate your contributions or earned income.
Perfect. Thank you for the clarification. So the tax-free growth in a Roth IRA is a strategic planning tool to try to ensure that you are lowering your lifetime taxes paid. So Eric, what situation would you advocate contributing to a Roth versus a traditional?
Typically, you'll want to contribute to a Roth in years where you believe your earnings are less. Well, it really doesn't have to be earnings. It's not limited to just earnings. It could be something like taking money out of an inherited IRA, for example, things that are going to increase your taxable income. So when your taxable income is artificially low or expected to be lower today in the present year than in the future, that's when you'd want to choose a Roth, right? That's when you want to choose a Roth, all else equal. There are other strategies, right? Like leaving more money to your children, your descendants, or you want to actually do some math there and think, or some thought and some math. you want to think about their tax brackets, right? So even if my tax bracket is, let's say 24%, maybe even 35%.
Yeah.
If my kids are in the 37+% tax bracket because they're both doctors and lawyers or high earning professionals, then I may actually still want to pay at 35. Alternatively, if I'm brushing up against the lifetime annual exclusion, which would be a great problem to have because it's $15 million a person now. But if I'm somehow brushing up against that, and I'm trying to figure out how to handle this, I want to go pay more taxes so that my estate total is actually lower and I can pass more within a Roth shell so that they don't have to pay the tax once they get it.
Correct.
Which is a little bit more, we didn't need to dump into the granularity
it's a bit
of estate
weedy,
planning.
But yeah, I think that in general, right, you're talking about contributing to a Roth in years where your income or your tax bracket is lower.
The expectation is that it's lower than in the future, right?
Correct.
So, yeah.
So typically you're thinking young professionals for sure, right? Where your income or your earning potential is just going to continue to raise.
Certainly.
Okay. So we had discussed earlier, Eric, how, the Roth accounts itself were kind of a taboo thing in the late 90s for sure, early 2000s. They've become a lot more mainstream, especially like our generation is very familiar with it. And now workplaces are starting to even offer like Roth 401k options.
Mm-hmm.
So let's talk about some of the differences. Sometimes when you see the word Roth or hear the word Roth, you just think everything's the same, right? Like Roth conversions, Roth contributions, Roth 401k.
Okay.
And so it can get really, really confusing to differentiate between all of these things, right? Sure. So we talked today about contributions. We'll be talking about conversions in a later episode.
Mm-hmm.
We talked about the Roth IRA, right? But so that's you on your own. So let's discuss briefly the Roth 401k option.
Okay. Roth 401ks are usually present at your workplace. Well, they're going to have to be present at your workplace, right? It's a type of 401k. Yes. My point was, not all employers will offer the Roth 401k option.
Correct.
It's considered like a more complicated option for your TPA or third-party administrator, on the plan. It just makes their life a little harder, the people that are administering the 401k plan. So the idea is, though, that the Roth 401k option functions almost identically to the 401k option. Typically, the investment offerings are the same, right? It's the only difference is you're going to be paying the tax on the money that you're deferring. And what I mean by that is you're always going to pay the FICA taxes, whether it's Roth or traditional IRA deferrals, right? But now I'm going to also pay state and federal income taxes. Okay, so
the money I'm deferring is going to show up on my W-2.
Exactly correct.
Yeah.
Exactly correct.
So typically, right, you'll see or you'll get your W-2 if you're contributing to a traditional, like a regular 401k, you'll see that it essentially lowers the amount of income that's reported on your W-2.
Yeah, you'll notice that your gross wages are reduced by the amount that you contributed, or all your pre-tax deductions, which are typically going to be 401k deferrals. And then you'll see like your Medicare earnings, and then you'll see that being the total number of your actual earnings, right? Because you're paying Medicare. Remember, we're paying Medicare and Social Security tax
regardless
on all of these, regardless, right? Because that's considered FICA or payroll taxes. So you're paying that still, but you're going to avoid the income tax component.
So if you've ever looked at your W-2 and you've seen that like boxes 1 and 2 and 3, like there's slightly different numbers, that's why.
That's why. Exactly. So the contribution limits for Roth and traditional 401k deferrals are going to be the same for the employee. So it's $23,500. And then there's a catch-up provision
if you're
50 or older, and that's $7,500. So an additional $7,500. So you can get to $31,000 of deferrals.
But if
you can also split that if you wanted to. You can go half traditional, half Roth.
That's a good point.
You can slice it however you want.
But the most interesting thing, or the first thing that I hold on to when we're discussing that is that.
What do you hold on to?
I do hold. Thanks. Is that like with a Roth IRA, right? The majority of people are capped at 7,000, right? And we know that while that's a great start, it's not alone enough to really sustain retirement.
Sure.
But then if I could get up to like 23,000 or potentially even like 31, I'm tripling, quadrupling.
Sure.
what I can do in a contribution. So
there's a lot more.
We've done
more power there.
correct. And we've done previous episodes about, or a previous episode about being able to kind of quantify a full package for a job that is something beyond, your paycheck. And so if this is something that you value and are interested in, having a workplace that offers a Roth 401k option.
Certainly helpful, yeah.
Yeah.
Optionality is always great. That's
For
a good
sure.
one to have. One more thing real quick. The catch-up contribution on the Roth, I'm reasonably certain that we said it, but if we didn't, it's $7,000. And then if you're 50 or older, you get an extra $1,000. So then it's $8,000 is your annual limit on your direct contributions. Does that make sense? To a Roth or traditional IRA.
Mm-hmm.
And then the 401ks have their 23.5 and then 31.
Perfect. Excellent. So then the Roth 401k essentially raises the limitation on, or the cap on how much money you can contribute or defer in this case.
Mm-hmm.
The second thing that I find interesting is the difference in the income limits as well, right?
For
401k versus the IRA.
Oh, they just don't exist.
Exactly.
For the
now,
401ks.
Correct. So we discussed that the people who typically are going to want to take advantage of a Roth option are people who are in lower tax brackets. Mm-hmm. So once you start going beyond those income limits, it may no longer be advantageous to you. But with a 401k, you have the option of being able to determine that yourself rather than the government saying,
some people have very strong views about taxation and when they want to pay it. And, I'll pay all my taxes now so that I don't have to later.
I don't want to worry about
rip
it.
the Band-Aid off. Yeah, exactly. I don't want to have to worry about taxes and retirement. That's fine.
Yeah.
Right. So you can do that with the 401k option.
Correct. All right. So we're going to move on to the third section of our conversation today, which if you are familiar or have read up on the Roth accounts at all, you may have heard about something called the 5-year rule. And so that is what I want you to explain to us right now, Eric.
Okay. So there's two.
There are two.
The first 5-year rule has to do with the account, the length that the account has been opened, right? So you have to have your Roth IRA open for 5 years before your earnings can be taken. Before.
Try again.
One day I'll be able to speak
Try
English.
again.
Before your earnings can be withdrawn, tax and penalty free. Does that make sense? So you need to have the account in existence.
Okay,
right?
so it's 2025 right now. I open my Roth account today. Next year, let's say I contribute. This is actually an interesting scenario. Okay.
Uh-oh.
I open my Roth account today.
Okay.
I put in $5,000.
Got it.
Next year, my hot water heater breaks or my air conditioning breaks.
Okay.
I don't have funds to pull from anywhere else. I'm going to unfortunately, we would never advocate this, but I'm going to unfortunately have to pull from my Roth.
I'd be very sad. Yes.
My Roth account is now $7,000. It's gone from 5 to 7. I need, $6,000 for my AC.
Sure.
Okay. The $5,000 that I pull out, which was my original contribution, what is the tax treatment on that?
Contributions are always tax and penalty free.
Beautiful. So if you're on the fence about a Roth or about your time horizon or anything like that, your contributions, you can withdraw tax and penalty free inside the 5-year rule.
Yes. Separate and apart from 5-year rules.
Perfect.
Any other thing that you might be thinking about.
Now, I said I need an extra $1,000, which is coming from the earnings. My account has not been in existence for 5 years.
Correct. The earnings will come out and you will pay taxes and a 10% penalty, assuming that it's not a qualified withdrawal. We're not over 59.5. In that case, you'd still, I believe, pay taxes, but not the penalty. Could be wrong there, actually. Yes.
This is a really
Roth
specific.
rules are incredibly complicated.
Correct. Like there are little caveats for different ages and life situations. Sometimes they'll allow you to take out a certain amount of money for certain life events that are qualified. It's incredibly punishing.
If you're inside of the
to not
5
know.
years and it's non-qualified, you're almost certainly paying taxes and 10% penalty.
Correct.
That's the answer.
So in order to be outside of the 5-year rule, my account needs to be in existence for 5 years. So let's say I open the account in 2025 and I put in $100.
Okay.
Okay. Then in 2029, I contribute $5,000.
Okay.
Right. In 2030, it's grown. In 2030, the account's been open for 5 years, but I didn't make that large contribution until last year.
Still fine. You can withdraw
Because
everything.
the account has been
in
open
existence
for
for
5
5 years, assuming that it's a qualified withdrawal again. And
Correct.
qualified withdrawal, the most common is you're over 59 and a half. Okay, that's the most common. But then there are others like death and disability. I think it's like $10,000 for the purchase of your first home.
Yeah.
There are a number of rules.
There's something for education.
Yeah, they differ slightly between traditional IRAs and Roth IRAs. So I mean, you can, a quick Google will give you that list, and most of it, you won't have to hopefully encounter very much.
And they have capped amounts. So it's not like, oh, I can just pull out my whole Roth. Correct. So definitely know the rules. I will say, and we know this from experience with people that we know. If you are to withdraw funds incorrectly,
yeah, you can't really undo it anymore. You used to be able to recharacterize and kind of mess with the Roths and the Roth conversions. Now, when you've done that, you cannot.
It's really unforgiving.
Before the end of the tax deadline, you can recharacterize Roth contributions as traditional contributions or non-deductible IRA contributions. There are things you can do there if you realize, like, oh, wait, I contributed and I shouldn't have, right?
Like for example, I didn't make $7,000, right, but I contributed $7,000, right? And you have to have earned the amount of income. So if you contribute $7,000, but you only earned $6,000, right? Before the tax filing deadline, you can take that extra $1,000 and change the categorization.
Yeah, and you can usually work with your custodian and they'll help you out there.
But for withdrawals.
Right. So we talked about 5-year rules. So the first one is the account has to be open for 5 years.
Okay.
There's a separate 5-year rule on Roth conversions, right? So the amount of the converted funds needs to be in the Roth account for 5 years before you can withdraw the converted amount tax and penalty free. Right. So remember, contributions, we said, which is just you putting the money straight into your account from like your taxable account to your Roth. Right. That's a contribution. That's a direct contribution. You can withdraw that at any time, tax and penalty free. The second is a Roth conversion, which means you have some amount of dollars in a tax deferred account, typically a traditional IRA of some sort. Right. Or it can be a rollover IRA, but it's going to have a tax deferred status. Right. So typically, you're going to convert those funds. That's a Roth conversion. Okay, when you convert from a traditional IRA into a Roth IRA, and at that point, you pay the taxes on all of the funds.
Correct.
Okay, so you're not going to have to pay taxes again on the funds that you've converted. Right. However, if I withdraw those funds, so say I convert $5,000, all right, and then I immediately withdraw my $5,000 from my Roth, I have to pay a 10% penalty or $500 on the $5,000. For just ripping them out immediately. Because I didn't wait 5 years. I just immediately pulled it out.
Yeah.
So every conversion has its own 5-year clock
timer
on the actual converted fund limit. And
this is where it gets confusing because you're talking contribution, conversion. Right. They sound similar. They both have to do with Roths. They both start with C. They do. It's very, very confusing.
Yeah.
So today's episode, what we have been talking about with the $7,000 limit and all of that is a contribution.
Correct.
Which upon contributing, you can then withdraw the contribution itself, tax and penalty free. The conversions, which we're going to talk in detail about in our next episode, has the slew of rules, like Eric was saying, where each contribution, so like
each conversion.
Thank you.
Yes,
each conversion. Confusing. So if I do a Roth conversion in 2025, that conversion, I cannot pull out without paying penalties till 2030, right? But then next year in 2026, I'm going to do a conversion. That one, I cannot pull out in 2030. It has a separate timer.
Correct.
So 2031. So for the contributions, it's the timers on the account itself. For the conversions, the timers on each conversion.
That's exactly right.
Yeah.
And then just one more thing to reiterate. Contributions, direct contributions, always, forget all the 5-year clocks, you can pull those out tax and penalty free.
Yeah.
So if I've aggregated, directly contributed $40,000 to my Roth over a number of years. Maybe my Roth value is $100,000. Okay, so I contributed $40,000. Current value is $100,000. I can always pull $40,000 out of my Roth,
Correct.
and I don't have to worry about it.
Yes.
Right? I just need to know what my basis or what I've contributed. Right? What my basis is.
And this is where theoretically, right, like the system, the banking system that you're using should have records. However,
right.
It is.
Make sure you track it.
Yeah, it's
so
best
that if
practice.
You get audited, you can say, "Hey, look, here
This
it is.
is what happened." It's best practice to keep detailed records of your contributions, your conversions, their dates.
Correct.
You can even like look online for like a Roth tracker. They have all sorts of them out there. But keeping your own records is going to be better than trying to rely on.
The only other point I'd like to make on the conversions and contributions, I know it's tedious, it's cumbersome. There's also an ordering rule. So if I have, like people will say, wait, well, I did a conversion and I also contributed some dollars and then I have earnings.
Yes.
What if I pull $1,000 out? How does anybody know what that is? So there's ordering rules for the withdrawals from Roth IRAs. And those rules are the first money that you take out will always be contributions. So everything that I take out is treated as a direct contribution until I've used all of my contribution amount up. And then it's all of the conversions. Okay. And then it's earnings on contributions and then earnings on conversions. However, the earnings are essentially going to be the same.
But in all honesty, it ends up going from like the least restrictive to the most restrictive, like withdrawals, essentially, right? So on your contributions, right, you can at any point withdraw them tax and penalty free. So it makes sense that those would be the first dollars. But if you don't have records that indicate to you how much money you have in contributions, you don't know at what point you're switching over into your conversions and then making sure that you have funds that have been in there for at least 5 years, because you might get hit with a surprise penalty bill. That's never fun.
Yeah. The only other thing, it's somewhat complicated. I don't need to add another rule or another rule.
There's a lot. There's a lot to know.
If you're over age 59 and a half and you make a Roth conversion to an account that's already been in existence for 5 years, you can pull that out immediately tax-free. Tax and penalty free. Does that make sense?
Because of your age.
Correct. Because it's already considered qualified. You're already over 59 and a half. And you've already paid the ordinary income tax at the point in time you converted it.
Yep.
So they were not going to make you wait 5 years on each conversion when you're over 59 and a half.
Correct.
Even if you're, yes, right when you're 59 and a half, that 5-year rule vanishes. You're only worried about, the 5-year rule on the conversions kind of vanishes, right?
The 5-year rule on the account.
But the 5-year rule on the account still very much applies.
And again, this is why we're discussing this, and this episode is kind of the basics of it. There's a lot to know. And so when you're talking about the 5-year rule, there's 2 rules, and both of them are 5 years. There's conversions and there's contributions, and then there's different treatments on the earnings. And there's so much to know that, typically you'll find people who just don't want to even bother with it because it's so complicated and can be so punishing if done incorrectly.
Right. Before we get to the Q&A section, just to distill this into what we're talking about, right? Like just what is my takeaway if you had one thing to say?
Yeah.
Roth conversions are very, very fantastic planning tools. They're great accounts. You want dollars in Roths more than anything else because they grow tax-free forever, right? So if you're thinking about retirement, broadly speaking, we're always going to have withdrawals after 59 and a half or for the vast majority of the time. Even if we're planning on retiring early, we can take contributions out tax and penalty free. So even if we're retiring early, we could pull that money. But just to distill it, Roth IRAs, fantastic tool. You want to use them if you think your earnings now or your taxable income now is less than it will be in the future. And what I mean by that is taxable income to put you in a bracket. Does that make sense? So we're really concerned with the effective tax rate and the marginal effective tax rate that we always like to talk about.
Yeah.
We're just interested in your marginal bracket plus all that's a fancy way of saying we're interested in your marginal tax bracket plus all of the, penalties or credits that you could either gain or lose. Does that make sense? The additional, I shouldn't say penalties, additional taxations like net investment income tax, your Medicaid, IRMA tax.
All the beautiful hidden things.
I like that I said I'm trying to distill and then I went on this tirade.
He's not. So essentially, while we're discussing how complicated the rules and things are, it is not to say that that complication negates the value of
No, it's fantastic.
Roth accounts.
You should certainly use them.
Correct. It's just that in using them, you want to be well educated and knowledgeable about the rules so you're using them appropriately and to your best benefit. And if it is something that you want to know more about, there are a host of professionals that are available that can help walk you through them.
Yeah, there are resources online.
Correct. And, there are people who will approach us asking for help with like Roth conversions over a number of years.
Sure.
Or identifying how much to contribute or convert to their Roth just for this year, or whatever the case might be. There are professionals who are available if it's too daunting.
Yeah.
But please don't avoid the Roth conversation because it's overwhelming.
I just long-windedly want to say Roths are great. Use them.
They are. Okay, so we've talked about Roths many times over the existence of our podcast. And because we've gotten so much interest and questions on this topic, this is why we're kind of doing the 3-episode mini-series. But I pulled some questions that we've gotten previously about Roth basics for you to kind of distill those answers there.
Hopefully I can
distill.
Hopefully I can get it done.
So there's 3 of them, okay? The first one, can I contribute to both a Roth IRA and a Roth 401k in the same year?
Yes, and with the same funds.
So that's pretty incredible. So when you say with the same funds, like I know I can only contribute, like let's say that I'm under 50.
Mm-hmm.
I can only contribute 7,000, right? If I'm 50 or over, it's 8?
Correct.
Okay. So I have a set number I can contribute and it has to be with earned income. So let's say I worked part-time this year. I made $7,000.
Okay.
I have some savings as well. So I could contribute $7,000 to my Roth IRA.
Yep.
Okay. I could also contribute $7,000 to my Roth 401k.
Correct. Your line 11 on your tax return is what we're going with here. That's your AGI, and you're actually going to add back some of the deductions to determine what your modified adjusted gross income is for Roth contribution purposes.
Mm-hmm.
So if you're making a Roth 401k contribution, you're not actually reducing your AGI at all. You're not.
So you could essentially double dip.
Yes, you could if you wanted to, and you had the taxable savings
funds
to do
so.
Right?
Yeah. Perfect. So you can contribute to both, and if you're eligible and have the means, you could max them both out as well. All right, second question. What happens if I contribute, and we touched on this actually earlier, what happens if I contribute to a Roth IRA, but then I discover that I'm over the income limit?
You can speak with your custodian and recategorize your contribution or withdraw your contribution before the tax filing deadline. If you leave the money in there, I think it's a 6% excise tax that you will have to pay.
Mm-hmm. And the same thing goes for if you were to contribute, but you were under the amount of earned income that year. Same thing. Okay. And then our last question that I pulled for this episode, are there required minimum distributions for Roth accounts?
No. Used to be for Roth 401ks. They discontinued that with Secure Act 2.0, I believe.
Excellent. So an important distinction between the Roth and non-Roth accounts.
Correct.
All right. So those are essentially the basics for the Roth that I had that I wanted to talk about. Is there anything else that you wanted to talk about?
That's it.
All right. So essentially, main takeaways, right, are that the Roth accounts offer the tax-free growth option, should be taken advantage of in years where your taxable income or your bracket is lower than what is expected to be in the future. The 5-year rules determine when those earnings can be withdrawn tax-free. And the Roth accounts are incredibly beneficial, which we're going to dive into more in next week and the week after.
All righty. Thanks, guys.
Till next time.